Okay, welcome once again to CN Professional Institute. We are still on IFRS 15 revenue from contract with customers. This standard is a bit broad, so we really have to look at it very well and then cover every angle, right? So in the last video, we looked at step four. Step four, here, allocate the transaction price to the separate performance obligations. Allocate the transaction price to the separate performance obligations. So we looked at this question, we solved example 1, we solved example 2, right? Let's solve example 3 and then look at step 5. Okay, so the previous example we solved were on allocation of the discount, right? So let's solve a question where we have to allocate the transaction price as spelled out by step 4. Okay, so let's look at this question. It says Shred who sells a machine and 1 year's free technical support for $100,000. It usually sells the machine for $95,000, but does not sell the technical support for this machine as a standalone product. Other support services offered by Shred Co. attract a markup of 50%. It's expected that the technical support will cost Shred $20,000 required. How should the transaction price be allocated between the machine and the technical support? So the question is, we should allocate the transaction price between the machine and the technical support. So we are doing allocation of the transaction price. In the previous videos, we allocated the discount. Here it says we should allocate the transaction price. So what do we do? Let's go and look at the things. This 100 here is what we call the transaction price. So the TP, it says Shred usually sells the machine alone for 95. So this is the standalone. This 95,000 is the standalone selling price for what? The machine. Are you following? So we have to get the standalone selling price for the machine and then the standalone selling price for the technical support. Then we sum them and we can allocate the discount, right? So but when we come here, we are told that the technical support cost Shred what? $20,000. So this $20,000 is the cost price of what? The technical support, not the selling price, not the standalone selling price. It is the cost. So we have to convert the cost to selling price. We have a markup there, so we can convert the cost to what? Selling price, right? So let's do something here. We'll go back to the question. So let's say we have the product here, standalone selling price. Okay. Then let's bring the discount here. Okay, and then we have the allocated transaction price. Let's do this way. So the product, we have the machine, and then we have the technical support. So these are the products, right? What are their standalone selling prices? If you are selling them alone, how much are we going to sell? The machine, we were told that the machine alone is sold for what? 95,000. Are you following? The machine alone is sold for 95. The technical support, we were told that it's expected that the technical support will cost Shred what? 20,000. But I'm saying the 20,000 is not the standalone selling price for technical support. It is the cost. So you have to convert the cost to what? Selling price. How do we do the conversion? Let's come and do it. As you know, selling price is equal to cost price plus profit. I'm sure you are aware. It cost Shred what? 20,000. That's the cost price of the technical support. It's here, 20,000. Now the profits here, we are told that the markup is 50%. And we know markup is on what? Cost price. Are you following? So the profit will be the 50% of the cost price, 20,000. So 50% of 20,000 markup is applied on cost. So apply the 50% on the cost, 20,000. So 50% of 20,000 give us what? 10,000. So the profit is what? 10,000. So when you sum the 20,000 and the 10,000, what do you get? 30,000. So 30,000 is the selling price for the technical support. I am saying it is the selling price. In the question give us 20,000. The 20,000 is not the selling price, the cost price. So you have to get the selling price. So technical support sells alone for what? 30,000. Are you following? So that's the standalone selling price for technical support. So let me wipe this one. I want us to work everything here. So let's wipe this. There's complication here. So let's go back. So we have to sum all this to get the sum of the standalone selling prices. This will give us 125,000. I following. But see, so when you sum the standalone selling price for machine and technical support, you get 125,000. But if you come into the question, we're told that they did the two. They did the technical support and then the machine, everything for 100,000. So 100,000 is the transaction price. So we see when you compare the standalone selling price, right, which is 125,000 minus the standalone minus the transaction price. Okay, the sum of the standalone selling price is 125, transaction price 100. So you see we have a discount of what? 25,000. Are you following? So in this case, we have a discount. But here we are not allocating the discount, we are allocating the transaction price. Are you following? Now, how do we allocate the transaction price? How do we allocate the transaction price? So how do we share? So the question said we should share the transaction price. That's what it means. So it's very, very simple. To share the transaction price, just pick as we know. So a machine, okay, you come and pick this one, 95,000, okay, divided by the total, 125,000. By the transaction price, what is the transaction price? 100. Here we are. The question we should allocate the transaction price. That's why I'm doing this way. We are not allocating the discount. So 95,000 divided by 125,000 by 100,000, you have 76,000. So 76,000 is the amount that we have to allocate for what? The machine. By following, we are allocating the transaction price, not the discount. And then we go to the technical support. When you go to the technical support, the standalone selling price was 30,000 divided by the total 125,000 times the transaction price 100,000. And what do we get? What by 100,000? What do we get? We will get 24,000. Are you following? The 24,000 is what we are going to give to technical support, and 76 is what we are going to what? The machine. So that's the allocated transaction price. So we are done allocating the transaction price. So if you want to use a table here, we can equally use a table here. You can fill the table. So look at it. For machine, okay, check something. For machine, the standalone selling price was 95,000. But after the allocation of the discount is 76. Are you following? After we are done allocating not the discount, sorry, after we are done allocating the transaction price is 76. So machine is taking 76 of the transaction price. Standalone is 95. Transaction is 76. The transaction price allocated to what? The machine is 76. So what's the difference? 95 minus 76. What do you get? 19. So you get 19,000 is a discount for what? The machine. Are you following? So we can equally look for a discount. And then for technical support, the standalone price is what? The standalone selling price is 30,000. But after allocating, what did we get? We got 24,000. Are you following? We got 24,000. So the difference between the 30,000 here and the 24,000 here allocated here is a discount, which is what? 6,000. So we see there was a 6,000 discount allocated to what? The 6,000 discount allocated to what? The technical support. Are you following? So when you sum all this, 19 plus plus 6, 19,000 plus 6,000 will give us 25,000. So you see that 25,000, we've gotten the discount back, 25,000, right? And then 95 minus 19 will come and give us what? The 70 what? 6,000. Are you following? And then 30,000 minus the discount 6,000 will give us 24,000. Like for instance, you can see this has the allocated transaction price here. The 76 up here and the 24 here. They are what we got here. I following and here. So when you sum this, you get the 100,000. So that's all. The question said we should allocate only the transaction price, but I allocated transaction price and I showed you how we can get the discount from the what? The allocated transaction price. So when you're done with allocation, when you're done allocating the transaction price, compare the allocated transaction price with the standalone selling price. The difference will be the discount. Are you following? So when you take machine, the standalone selling price was 95. The allocated transaction price was what? 76. So it's between 95 and 76. Is there this discount here? Technical support, standalone was 30, allocated was 24. So the difference was 36,000 discount, right? So that's how we are going to do the allocation. We have so many ways of doing it. Okay. We have so many ways of doing it. You can even allocate the discount first. And you come and deduct the discount from the standalone selling price and you get the transaction price. If you want to allocate the discount alone, you pick for machine, you pick the 95 here, divide by 125 times the discount, what we did in the previous step. Okay. So you pick 95,000, divide by 125 times the discount, 25. So you come and get this 19,000. Then you pick, next one, you pick 30,000, divide by 125,000 times the discount, 25,000. Also come and give you what? The 6,000. They deduct the discount from the standalone selling prices, and that will also give you the allocated transaction price. So we have so many ways of what presenting it. But the question is to allocate the transaction price. That's why when I got here, I multiplied by the transaction price 100,000, 100,000. And the difference between the standalone price, selling price, and the allocated transaction price is the discount. Okay, good. So that's it with step 4. That's it with step 4. Allocate the transaction price to the performance obligations. Okay, so let's continue with step 5. Recognize revenue when performance obligation is satisfied. Recognize revenue when performance obligation is satisfied. So we looked at step 1, 2, 3, and what? 4. Right? So let's at step 5. When do we recognize revenue? When do we recognize revenue? Right? So it says revenue is recognized when or as the entity satisfies a performance obligation by transferring a promised good or service to a customer. Right? So revenue is recognized when the entity satisfies performance obligation by transferring a promised good or service to the customer, right? And it says that for each performance obligation identified, an entity must determine at contract inception whether performance obligation is satisfied over time or performance obligation is satisfied at a point in time, right? So we have to look at it from the very day we start the contract, from the very day we enter into the contract at contract inception. We have to ask ourselves, is performance obligation satisfied over time or at a point in what time? I get it. And that will help us to recognize revenue, because if performance obligation is satisfied over time, we have a way of recognizing revenue. If it happens at a point in time too, there's a way of what recognizing revenue. So at inception, the very day you've entered into the contract with the customer, you have to determine whether PO is at a point in time or over time, and that will help you recognize what revenue, right? So let's look at the first one, where performance obligation is satisfied at a point in time. Performance obligation is satisfied at a point in time. This is if a performance obligation is satisfied at a point in time, then the entity must determine the point in time at which the customer obtains control of a promised what asset. So it says if PO or performance obligation happens at a point in time, then we have to determine at that point in time that the customer obtains control of a promised product, of a promised asset. Now, this what we mean when we say performance obligation is satisfied at a point in time. Let me give an example. You see, when you sell to a customer right now, probably you sell a car or you sell a bag of cement to a customer right now, but the customer obtains control over the product right now, and you record revenue. It has happened over time. Just transfer the goods to the customer right now. The customer obtains control over the cement, control over the car, and you can record the revenue right now. So that's performance obligation at a point in time. But over time, you are not performing your PO at a point in time. It will happen over time. An example is you go into a contract with a customer to construct, or and you're going to a contract with a customer to perform service, okay, after sales service for the customer for 5 years. You can't record, it doesn't happen at one point in time, it happens over time. It will happen over the 5 year period, right? So that's performance obligation over time. So you can record all the revenue that will accrue, or all the revenue for that 5 years. You can record everything in just a year. Performance obligation happens over time. You don't just perform or just do your you don't perform the obligation, just do you don't just do the action. I mean, you can't just record revenue once. It happens over time. So your performance, it does happen over time. I get it. Your obligation will not happen in just a day or in just a year. It happens for 5 years, or it will happen for 5 years. So that's performance obligation over time. I get it. So it says if performance obligation at a point is at a point in time, they have to determine that point in time that the customer controls what the product. And if we've been able to determine that the customer controls the product, then we can record what? Revenue. I get in it. And then the standard further define control for us. It says control of an asset refers to the ability to what? Direct the use of the asset and substantially obtain here and obtain substantially all of the remaining benefits. Okay. Into brackets, what? We have what? Inflows or savings in outflows from the asset. So saying, okay, control of the asset is the ability to what? Direct the use of the asset and substantially or virtually obtain all the benefits that relates to the asset. So if you can direct the use of the asset and get virtually all the cash flows that relate to the asset, then it says what? You control the asset. And it says control includes the ability to prevent other entities from obtaining benefit from what? An asset. So if you control the asset, you can prevent others. You have the authority to direct others to prevent them from what? Obtaining benefit that relates to the asset. So that's the standard is saying, okay, if performance obligation happens at a point in time, they will have to determine that point in time that the customer controls the asset. And when we get to that point in time that the customer controls the asset, then we can record revenue at that point in time. As simple as that. So immediately the customer controls or obtains control of the asset, then we can record revenue at that point in what? Time. Right? And then the standard further give us indicators of control. What shows the customer controls the asset? What shows the customer controls what? The asset. Right? So we have the indicators of control. One, it says the entity has present right to payment for the what? The asset. So you the one selling, you have for present right to demand payment for the asset. The customer has obtained what? The legal title. So you've passed the legal title to what? The customer. Legal title has been transferred to the customer. Then it says the entity has transferred physical possession of the asset. Okay, so you've taken the goods from your premises, you the entity, you the seller, you've transferred the physical possession to the customer. So you place you've transferred all the goods. Okay, let's say the 50 bags of cement, you've transferred everything to the customer. You've taken it from your store, your warehouse, whatever, to the customer. So you've transferred the physical possession of the asset to what? The customer, right? And it says the customer has significant risks and rewards of the ownership of the asset. So now that you've transferred everything to the customer, if anything or if the good is missing, is damaged, is stolen, is destroyed, burned by fire, you the entity, you the seller, you don't have anything to do with it. It is the customer that will bear it. That is what we mean by significant risk and rewards have been transferred to the customer. Okay, so we've passed all the risks and the rewards to the customer, and then the customer has what? Accepted the asset. So if these conditions are met, then we say there's control, and immediately there's control, then the sign says we should record what? Revenue. We can record revenue when these conditions are what? Met. So these are indicators of what? Control. I get it. So this performance obligation that happens at a point in time, and as I said, this one is normally our previous IS 18 revenue. right? You sell goods today, you transfer the legal title, the physical possession, the risk and the rewards, everything, just pass it to the customer, and the customer accepts the asset. So if these conditions are met, then we said, okay, we've passed control to what the customer, and we have the right to record what revenue. As simple as that. You sell car today, you've taken the car, you've transferred the car from your warehouse to the customer. The customer has accepted the risk and rewards, you've given the legal title, you have the right to payment, the customer has accepted the asset. When these conditions are met, you record your what revenue. This is performance obligation at a point in what time. Let's look at performance obligation over time. So I give an example that you are performing service for a customer for 5 years. That is over time. So your obligation, you the entity, your obligation will not just be once. You keep performing for the 5 years. So that's performance obligation over time. Performance obligation what? Over time. Right. And this is an entity transfers control of good or service over time. And therefore satisfied performance obligation and recording revenue over time if one of the following criteria is met. So we are saying, okay, for us to see this performance obligation over time, these conditions should be met. One, don't forget, it's only one. If one of these conditions are met, then we can say performance obligation happens over time. Okay, and therefore we apply the rules as we are going to apply the rules, okay, of performance obligation over time to record revenue. So we said if performance obligation at a point in time, that's straightforward. Immediately the control of the asset has been passed to the customer, you record revenue. But performance obligation over time, we have a way of recording revenue, which is normally based on the progress. So we'll look at it. Okay, so since an entity transfer control of a good or service over time, and therefore satisfy performance obligation and recognize revenue over time if one of the following is met. So we have conditions to be met for us to see this performance obligation over time. One is, it says, one, the customer simultaneously receives and consumes the benefit provided by what the entity as the entity what performs. Okay, so as the entity performs, so let me give an example. You are building a house, okay, for your customer. Okay, so it says as you perform, as you build a house, the customer simultaneously receives and consumes the benefit. So the customer, as at the very time that you are performing, the same time that you are performing the performance obligation, is the very time that you are building the house, the customer is enjoying the benefit. Okay, is consuming the benefit that relates to what the asset. So this is the customer simultaneously receive and consume the benefit provided by the entity's performance as the entity performs. So as you are doing it, the customer enjoys the benefit at the same time continuously till the end of what your PO, till you are done satisfying your performance obligation. So example again is, let's say you enter into a contract with you enter into a contract with the customer, and then your performance obligation will be to provide, let's say, 3 year services. Let's say you are doing your payroll for them for like 5 years. Okay, now as you are performing, as you are doing your payroll, the same time the customer will be enjoying the benefits that you are providing. You are doing payroll for them, so every year you do the payroll. As you are doing the payroll for them for the 5 years, the customer will keep what enjoying the benefit as you perform. As you do your performance obligation, the customer will enjoy the benefit at the same time. Are you following? So since the customer simultaneously what receives and consumes what the benefit as you do it. Then says two, the entity's performance create or enhance an asset. For example, work in progress. That's what I've talked about. Example, what work in progress. So as you build for your customer, it takes some time for the building to get ready. As you build for the customer, okay, or as you build for the customer, you create an asset. It says the entity performance creates or enhances what? An asset. So as you do it, you are creating an asset, the house, or if not creating, you are enhancing the asset. Let's say you've getting to the first floor, the second floor, the third floor. Okay. As you do it, you are enhancing what the asset. So it's like work in progress. Okay. So as you do it, you are enhancing the asset that the customer what control. Are you following? So it says two, the entity's performance create or enhances an asset. For example, work in progress that the customer controls as the entity, as the asset is what created. So as you perform, okay, your performance create an asset, like the house, the building is an asset, or you enhance the asset. The building is already there, but you are enhancing it. You are adding value to the asset. So you either create an asset or you enhance what? The asset. Your obligation. Are you getting it? So normally it's very true. If you are building a house for a customer, it takes some time and it's normally performance obligation what over time. So as you do it, you create an asset, you create a building, or you enhance it, you add some features to enhance the asset. You are adding value to the asset, and then finally it says the entity's performance does not create an asset with an alternative use to the entity. Now with P over time, it's normally what we call customer specific. Like it's done specifically for a customer. So let's say you are doing payroll for a customer for 5 years. The payroll is designed for, like, you are doing for the customer. You are building a house for a customer. The house you are doing is at the customer specification. You are doing it per the specification of the customer. So as you perform, you are creating an asset, okay, for that particular, for that entity. You are creating an asset for what? The entity. And that asset to you has no alternative use. It's just that the entity performance does not create an asset with an alternative use to the what? The entity. So as you build a house to for your customer, as you build a house, you are creating an asset. But the asset you are creating, okay, since that asset has no alternative use, okay, to the entities. You are doing it purposely for the customer and into the customer's what? Specification. I get it. So it's very difficult to get alternative use for that what? That asset. Are you following? You are doing payroll for your customer. The payroll is to the customer specification. So it doesn't create an asset with other uses for you, the one doing it. Okay. So let's say you after you are done, the customer says, I don't want the house again. You've done it to the customer specification. So it's very difficult for you to get alternative use because it has been what? Designed specifically for that customer. Okay, customer made. It is tailored towards the customer's needs and preferences. So it's very difficult for you, the entity, to get alternative use for that asset. Okay, to look for other uses or to use it in a different form, to use it in a different way because it is done specifically for what? That customer, right? And it says the entity has what? Enforceable right to payment for the performance completed to date. You have enforceable right for payment. So if you've done the payroll for 2 3 years, you have the right to demand payment for that 3 year period and for the payroll that you perform for that 3 years period or the 3 year period. You have the right to demand payment, okay, for the payroll you perform up to that period, for that 3 year or 2 year period. You have the right to demand payment, right? So it says if one of these conditions are met, then we say performance obligation is what? Over time. Performance obligation is what? Over time. So we just need one to be met and we say PO is what? Over time. Okay. And it says when PO is over time, at inception, at the very day we are starting the contract, if we determine that performance obligation happens over time, then what the site is saying that for us to record revenue, we have to record revenue based on what we call the progress. Revenue is recognized by measuring progress towards complete satisfaction of performance obligation, right? So let me give an example. Let's say you go into a contract to build house worth what 10 million for a customer. Okay, for let's say 3 year period. Okay, so you are building a house worth 10 million for a customer for 3 years. Now, when do you record revenue? When do you record the 10 million as revenue? Is it the very day you sign the contract, or you have to wait for the 3 years? Do you have to wait for the building to be complete? Do you have to wait to complete everything before you record the 10 million revenue? Or do you also have to record revenue at the beginning of the contract? Immediately you start the contract, you have to record revenue. Can I say no? We don't have to record revenue, or we don't have to record the total amount. We have to record the whole 10 million the very time we start the contract. Neither are we supposed to wait till we finish the whole contract, till the 3 years before we record what? The 10 million revenue. It says we should record revenue based on the progress. So if you think, okay, year one, at the end of year one, you are 40% complete. Go and pick 40% of the total revenue. Go and pick 40% of what? The 10 million. If you think you are halfway through, 50%, go and pick 50% of the 10 million. Are you following? So we record revenue gradually if performance obligation is what? Over time. We record it what? Over time. Taking the payroll, for instance, let's say the period is 5 years. What you can do is you can just spread the total cost over 5 years. Divide the total payroll cost, the amount you are charging them. Divide that amount by 5 years, and then every year you record an amount. Are you following? So that's how we measure revenue. If performance obligations is what? Over time. We have to measure, or we have to record revenue based on the progress towards what? Completion. So if you think you are 40% complete, record 40% revenue. You are 50% complete, record 50% revenue. If you think you are finally complete, then record 100% what? Revenue. So we don't record all the 10 million ones, right? So that's how we go about that. So let's do more about performance obligation over time, right? Now, so we said that if performance obligation happens over time, we have to find what we call what? The progress. We have to find what we call what? Progress, right? How do we find the progress? So the progress is like a percentage of the performance obligation that we have done or we have satisfied. Okay. Progress is what? A percentage of performance obligation what achieved or what satisfied. How do we get the progress? Right. So I said if you think you are 40% complete, then you will apply 40% on the total contract price. Go and take 40% of the total revenue, and then that's what you're going to record as your what? Your revenue in your books for that year, for that period. Right. How do we get the progress that we apply on the total contract price? Okay. So the start is saying, okay, we can measure progress by two ways. One is what we call the output method, and the one is what? The input method. Okay, so this is the output method involves surveys of performance. For example, the value of work certified as completed so far compared with the overall contract price, or time elapsed, time spent on the contract compared to total duration. So you say, okay, if you want to use the output method, then we have two ways. We can pick work certified over the total contract price by 100. Work certified over total contract price by 100. Work certified over the total contract price by 100. Now, how do we get the total contract price? The total contract price is mainly or mostly spelled out in the question. Okay, that's the amount you are charging the customer for the whole project. I follow me. So if for the whole project you are charging your customer 5 million to build the whole house, the 5 million is your total contract price. So that's normally given a question. The next one is work certified. We said work certified over the total contract price. Okay, so work certified is a portion, okay, or a portion of the total value, okay, of the performance obligation that you think you have achieved. It is the total, or let me say, it's a portion. Work certified is like what? A portion of the total contract price that you think you've been able to achieve. You've been able to what? Achieve. And so therefore you have to the right what to recognize. Okay. And then with work certified too, it's mainly also in a question. Because work certified, most as I said, it is like a portion or the value of work that you think you've done out of the total contract price. I getting it. So we said with the output method, we pick the work certified over total contract price by 100. Or we can use the time, the duration. So if the duration is 5 years and you are now in the first year, it will be 1/5. So time spent, okay, over the total duration, also by 100. So pick your time spent on the contract divided by the total duration. So if you spent 2 years and the whole the duration, the life of your project will take 10 years, then you take 2/10 by 100. Are you following? So you take just 2/10 by 100, which should give us something like 20 what percent. So it means that 20% what complete if you are using time. So is this time spent on the contract or time elapsed over the total what duration? If the project is, let's say, 20 years, and you've got into year 5, okay, then the progress will be the 5 years divided by the 20 total years by 100. Are you getting it? So this is how we get the progress if we should use what? The output method. Work certified over total contract price by 100, or time spent on the contract over total what? Duration. We normally use the first one, which is the work certified over the total contract price. Okay, but you could see the second one, time spent over total duration. You can equally see that in questions. The second one is input method. So input method normally uses cost. So with the input method, we use cost incurred to date over total expected cost by 100. So you've estimated that, okay, for the whole project, okay, for the whole project, it will cost me 8 million to finish the project. So 8 million is the total cost. Okay. But as at the time that you are paying your extract, as at the time that you want to record revenue, what cost have you incurred so far? What cost have you incurred to date? So out of the 8 million, what cost have you incurred? If you've incurred 5 million to date, just pick your 5 million to date, then you divide it by the total contract, the total cost. So you pick your 5 million divided by total cost. The total cost is what? 8 million by what? 100. Are you following? And that will give you your progress. That will give you your what? Your progress. Okay. So you just pick your cost you've incurred to date over the total cost by 100. Okay. And then the total cost will be the cost you've incurred to date plus your cost to complete. So cost to date plus cost to complete, put them together and get the total cost and multiply by what? 100. So that's the input method. It is cost you've incurred to date divided by the total expected cost times 100. So this is the input method. This is what we call the input what? Method, right? So this is how we get the progress. Immediately we get the progress, we are done. When you get the progress, you are done. If you get the progress, then as I said, you're going to apply the progress on the total contract price to get total revenue. Then you will also apply the progress on the total cost to get your cost of sales. Now there's a change introduced by ACCA as regarding the recognition of the revenue and then the cost, but we'll look at it. Okay, so this is how we get the progress. We have two methods, the input and the output. Sometimes the question will tell you which one to use, whether to use the input or the output, or sometimes the question will be silent. Okay. Now, presentation in the financial statement, we are still looking at performance obligation over time. Performance obligation over time. And I give an example, as you building a house for your customer. If you are building a house for your customer, and that will take 5 years, 6 years, 7 years, 8 years to complete, then it's likely that performance obligation will be over time. So how do you record revenue? What processes do you go through to record revenue? I said that you don't record the whole total contract price. The amount you are charging for the 5 years, for the 6 years, the 7 years, you don't record everything, but you record revenue based on the progress. If you are 20% complete, you record 20% revenue, right? So presentation in the statement of financial position. So presentation in the financial statement, okay? So if you are presenting in the financial statements, what do we do? So we look at the presentation in the profit or loss account and presentation in the statement of what? Financial position. Are you following? So we go through some steps. Are you getting it? In order to record revenue or our cost of sales, we go through some steps. The first thing you do is that calculate what we call overall profit or loss. Calculate what we call overall profit or what? Loss. I'll tell you the reason why we first calculate profit or loss, the overall profit or loss. So calculate the overall profit or loss for the contract. So ask yourself, okay, how much am I charging? If for the whole contract, for the 10 years, the 20 years that you'll be doing the contract, you are charging 10 million. Okay, write the 10 million down and compare the 10 million to the total cost. Since the total cost consists of both what? Cost to date plus cost to what? Complete. So put the two together and that'll be your total cost. And go and compare with the total revenue. So if your cost to date plus your cost to complete, the two, summing the two, these two, you get something like what? 8 million. Then you know you make a profit of how much? To what? Million. because the 10 million up there is the total contract price. That's the total amount you are charging the customer, right? And then you come and compare with your total cost. You too, for the whole life of the contract, for let's say the 10 years that you're performing the contract for the customer, how much do you think you incur? How much cost do you think you incur? You put everything together, and that's what you have. Okay, that's what you are going to have. Are you following? That will be your total cost. So you compare your total contract price, that's the total amount you're charging the customer, with the total cost. Then you get to overall profit. This 2 million here is not the profit that we are going to record in 1 year. It's the overall profit. We want to test something. Now, that's the same thing here. Can you see all? The all here is the same thing. We have the total price or the contract price, the less total cost. And we said this total cost has what? Cost to complete plus what? Cost to what? Date. Okay. So you put your cost to date together plus your cost to complete, and that'll give you a total cost. So I'm saying just compare the two, cost to date, or compare your total contract price with your total cost to get profit or loss. If you compare the two and you have a loss, let's say your total contract price is 10 million, but you think it will cost you 15 million, that'll be your total cost. 15 million to perform this contract. It means you have a loss of what? 5 million. Are you following? You have a loss of what? 5 million. Now, the standard says something. The standard says, okay, if you have a loss, if the contract will bring overall loss to you, then the contract, we have something called the onerous contract. Onerous, onerous contract. So, onerous contract is a contract where our estimated cost is likely to exceed the revenue or the estimated contract price. In that case, we'll make a loss. That's what we call onerous contract. The slide said, okay, if you expect to make onerous contract, and if the contract is expected to be onerous, like you make a loss, overall loss, then it says you should record all the loss in the first year of the project, or you should record the whole loss for the first time that you are paying your extract. The first time you are paying your financial statement, you record the overall loss. So is it all the loss should be recorded immediately? So this 5 million loss, it's loss for the whole contract. By the time I say record the whole loss immediately, or record the whole loss the first time you are preparing your financial positions, or the first time you are recording revenue, record the whole loss in the book for the first time that you are doing you are recording your revenue. Okay, record the whole loss immediately as a loss. So we'll look at questions like that, and we'll do more about it. So the first step we do is we compute the overall profit or loss to determine whether the contract is onerous or not. If it's not onerous, you don't have any problem. You follow the other steps. But if it is onerous, if there's a loss, you have to record the whole loss immediately, or you have to record the whole loss in your first time of recording the revenue, right? Okay, so that's the first step. Record overall loss, or you have to calculate overall profit or loss. Let's look at step 2. So keep these steps in mind. Step 2 is you determine the progress. Determine the progress of the contract. We've done it already. We said we have the input method and we have the output method. With the input method, we said it is cost to date over total cost times 100. And then with the output, we said it's work certified over the total contract price by 100. Or we can use time spent over total duration by 100, right? So this is it. With the input, it is cost to date over total cost by 100. And then the output is work certified over total contract price by 100, or time spent so far, or time elapsed over total duration. So step 2, that's what we looked at previously. I think in the 2 slides, in the last slide, right? We look at how to get the progress. So step 2, determine the progress. Then step 3, you go to your statement of profit or loss. You go to your statement of profit or loss, right? Step 3, you go to your statement of profits or loss. Now, if you remember, I said there was a slight change with the way we record our revenue. Okay, so If you look at this side here, this side here, this is the old way of recording performance obligation over time in our books. The one I've circled, that's the old way of recording performance obligation in our books. I mean, that's how we were recording performance obligation over time in our books. But there was a change. I think ACCA introduced this change in their 2024, I think November, and then March 2025. I think they revised their manual to include this change, right? So previously, this is how we record performance obligation over time. This is how we're recording performance obligation over time. So where performance obligation is over time, this is how we used to record it. We did the progress. When you get the progress here, the first one, come and apply the progress here. Come and apply the progress. Multiply the progress by the total contract price. Okay, and that give you the revenue. So here, that's what we have here. Okay, multiply your progress by the total contract price. Multiply the progress by the total contract price. Are you following? And that'll give you the revenue to recognize. When you are done, go to cost of sales. With cost of sales, you also multiply the progress by the total cost. Multiply the progress by the total cost. The total cost has both the cost to date and cost to complete. So put your cost to date plus your cost to complete, put them together, and that'll be your total cost, right? Then you apply the progress. So it's the progress by the total cost. That's how we're doing it. You add the two and you get your profit. With the new method introduced, with the new approach introduced, right? This is how we do it. We don't record. So with the revenue, it's the same contract price by the progress. So how much are you charging the customer? How much are you charging? The total contract price multiplied by the progress. So if you are 40% complete, multiply the 40% by the total contract price to get the revenue to recognize, right? So it was the progress multiplying your total price. The progress multiplying your total contract price, and that's what will give you the revenue here. The change is that when it comes to the cost of sales, we don't multiply the progress rate by the total cost as we did here under the old method. We don't multiply the progress by the total cost. We just pick the cost we incur to date as our cost of sales. We pick the cost to date as our cost of sales. So in the previous method, what we're doing is that, okay, if you want to get your cost of sales, multiply your progress. If 40%, multiply the 40% by your total cost, right? Multiply your progress by the total cost. That's how we're doing it. But with the new one, with the change, our cost of sales here, to get the cost of sales, we pick only the cost to date. We don't apply any progress rate on the total cost to get the cost of sales. We just pick our cost to date as our cost of sales. That's all. So that's the change. That's one change made. I'm following. So that's the change that has been made in the statement of profit or loss, right? And then if you come here, I wrote all. We have total revenue here, or revenue here, that's total price by the progress, then less revenue recognized in the previous years. It's the same thing. Now, if you are at the first stage of your contract, or you're about to record revenue for the first time, then there will be nothing like previous revenue recognized. So you just started the contract and you want to record revenue. In that case, what you do is just apply the progress on your total contract price, and that'll be your revenue. But if previously you've recorded revenue already, if you've already recorded revenue in the previous years, then what you're saying is that, okay, after you've applied the progress on the total contract price, after you have multiplied the progress by the total contract price, less the previous revenue you've recorded, less the previous revenue recognized. Are you following? So it will be your total price by the progress. Then if you have already recorded previous revenue, less it, because these amounts are cumulative. Okay, so let's say your contract is 10 million. First year you were 20% complete. 20% complete. So 20% of 10 million will give us, I think if I'm right, 2 million, right? So year one we record 2 million revenue. Then you continue. By year two, your progress has moved to 80%. So 80% of 10 million will give us 80% of 10 million will give us what? 8 million, right? So year two, you are 80% complete. 80% by the 10 million is what? 8 million. You have to record all the 8 million. You have to go and deduct the previous 2 million what recognized, because this 80% is what? Cumulative. It's not like the 80% for only that year. It's everything from the time you started to the time you are completing. Are you following? So it's cumulative. So when you get your 80%, when you apply the 80% of the 10 million, are you following? When you multiply the 80% by the 10 million, and you get the 8 million, you have to go and deduct the previous revenue you have what? Recorded. Go and deduct the previous 2 million you have what? Recognized. Are you following? And the 6 million is what we are going to record. That's what we have here. That you pick the revenue and you record revenue recognized in the previous years. The same applies to cost of sales. You pick in the previous method here, we just pick our total progress, or the progress by the total cost, and then we less amount recognized in the previous years, and I'll give you cost of sales for that year. It's because for profit or loss items, we only record items for 1 year. We don't record cumulative figures. So with profit or loss or in the P&L, we have to less any previous revenue what recognized, right? So this is how we're treating it. So let me cancel it because we are not going to use this again. But as we go on, I would be comparing, okay? So this is how we are going to do now. So here we said, or you just multiply your total price by the progress and you less revenue recognized in previous years. That is if you are not at the first stage of your revenue recognition. If you've previously recognized some revenues and therefore you are at the second or the third stage, okay, you have to go and deduct the previous revenue you have what recognized before you can record the difference as revenue recognized. The same applies to cost of sales. And we said now cost of sales, we just pick our cost to date as our cost of sales, and we'll go and less the previous, or we'll go and less previous cost of sales what recognized to get cost of sales for only the period. Are you getting it? I said this is P&L, and P&L we don't record cumulative figures. We only get the change for that particular year. Okay, so where the contract is at the second or the third stage, we are recording revenue for the second or third time. Then after you've applied your total progress, after you've applied the progress on the total price, you have to less any revenue recognized in the previous years. Cost of sales do the same thing. If you've taken your cost to date, you have to record the previous cost of sales recognized to get your cost of sales for the year. Okay, so this is what we are going to use now, or this is the method we'll be applying now to get our revenue. So this one here, so this one is the method I will be applying now. Okay, this one here is what I will be using now. So in the profit or loss account, very simple. We compute two things. We look at revenue and then cost of sales. The revenue is the total contract price by the progress, and our cost of sales will just be the cost to date. I said previously, our cost of sales, we were applying the progress on the total cost. But now, to get our cost of sales, we don't apply the progress on the total cost again. We just pick the cost to date as our cost of what? Sales. Right? So step 3, we look at the financial position. Let's go at step 4. No, step 3, we looked at, it was statement of profit or loss, how we present the statement of profit or loss account. Step 4, let's look at how we present it in the statement of financial position. Now, in the statement of financial position, we calculate two things. One is what we call contract asset or liability. Contract asset or liability. The one, contract asset or liability, and then 2, contract receivable or payable. Contract receivable or what? Payable. So these are the two things that we compute in the statement of financial position. If performance obligation is over time, in the statement of financial position, we calculate two things: contract asset or liability, and what we call contract receivable or payable. Now, here to the same thing. This one here is the old way we're looking at it here. This one. This is how we used to compute our contract asset or liability, and then the one on the other side here is the change that was made. So this is how we computed the contract asset or liability previously. This is how we're doing it. So with the contract asset or liability, you pick your revenue recognized to date. This figure here, revenue recognized, it is to what? Date. Don't forget that it is to what? Revenue recognized to what? Date. Why is it revenue recognized to date? It's because financial position items are cumulative. Are you following? Financial position items are what? Cumulative. They are not just one-time stuff. They are cumulative. So if you want to compute your contract asset or contract liability, okay, we pick what we call revenue recognized to date. Not necessarily revenue recognized in the P&L, but from the time we started the contract to now, how much revenue have we recognized? Then we less amount billed or invoiced. So don't forget that you can put that down. It's either amount billed or amount what? Invoiced. Now, let me explain them. The revenue recognized to date is very simple. You can get it in your P&L account. So when you come to P&L account here, okay, we have the revenue, this figure here, okay, that will be our what? Revenue recognized. If this is our first time we are recording revenue, okay, so we have it here. So revenue recognized to date. Amount billed is, or invoice, is the amount you are telling your customer to pay you. So you tell your customer, okay, I've gotten to let me see, the first floor, the second floor. So give me 5 million. Are you following? So I think you give me 5 million. Out of the 10 million, I'm charging you, give me what? 5 million. That's how much you are billing the customer. Or you can tell the customer, okay, I've gotten to the 7th floor, the 8th floor. So I think the value of work I've done so far is what? 7 million. The 7 million is become the amount you're billing the customer, because you don't want to wait and finish the whole thing before you tell the customer to pay you. So you bill the customer along. As you are going, you are billing the customer. So that is what we call the amount what? Billed or what? Invoiced. So you compare the revenue you've recognized with the amount billed. And that one is also what? To date. It's to what? Date. Don't forget the amount billed is also what? To, let me say, TD. To what? Date. Because this financial position items are cumulative. So it's what? To date. Are you getting it? And then you get your contract asset or liability. So if the revenue recognized is more than the amount billed, you get your contract asset. On the other hand, if the amount billed is more than the revenue recognized, then you get a contract liability. For example, you billed a customer 5 million. No, the revenue you've recorded the revenue of 5 million, but you billed a customer only 4 million. So in this case, you have a contract asset of what? 1 million. But if you record revenue 5 million and you bill your customer 7 million, you are billing more than the revenue you are recognizing. So there'll be a contract liability of what? 2 million. You are billing the customer more than what? You are billing the customer more than what you are billing the customer more than the revenue you have recognized. So there will be a contract what? Liability. So this, the new way of doing it, this one here is a new way. And I said this one is the old way. The one here is the old way. In the previous before the change, contract asset, to get contract asset or liability, we normally pick your cost to date, then you add profit or loss to date. If profit to date, you add. If it's loss to date, you add. And you less amount what billed. And then you get your contract asset or liability. But now we don't add our cost to date to profit and less amount billed. We just pick the revenue we've recognized to date, and then we less amount what billed. So don't forget that this is a new change introduced. So we are going to look at it. This one here remains fixed. It doesn't change. Our contract receivable or payable, it doesn't change. So let me cancel this one here. Instead, is the old one. Our contract receivable or payable doesn't change. You don't forget, I said in the financial position we have two things: contract receivable or payable, and then contract asset or liability. We've gone to the contract asset or liability. With the contract receivable or payable, we said with the receivable or the payable, we compare the amount billed or invoiced, either billed or what? Invoiced, to the cash received. Now, amount billed is not the same as cash received. They could be the same, but not. The amount billed is the amount you are telling the customer to give you. because of your progress. So you think, okay, you're almost done, like you've gotten to the 7th floor, the 8th floor. So you're telling the customer to give you what? An amount of money. So you're telling your customers, okay, I've gotten to the 5th floor, so I'm billing you. So you give me something like, let me change the color here. So you're telling the customer, okay, I've gotten the first floor, so you give me 8 million. You are billing the customer 8 million. If the customer gives you 7 million, you have what we call contract asset of what 1 million. Sorry, contract receivable, not contract asset, contract what receivable. So with the contract receivable or payable, you compare the amount billed, okay, with the cash you are receiving. So if you bill a customer 8 million and the customer has given you only 1 million, there's a contract receivable. You have 1 more million to take from the customer. So we call it contract what? Receivable. You billed 8 million, the customer has given you only 7 million. So you have 1 million more to take from the customer. So it's called contract what? Receivable. But if it happens that, okay, you billed the customer 7 million, sorry, you billed the customer 8 million, but the customer has given you something more. The customer has given you, let's say, 10 million. You have received more than you asked for, and that will be a liability in your books. So there will be a 2 million liability, which is payable. So this is contract payable. Okay, so I'm saying with the contract receivable, if the amount billed is more than the cash you are receiving, it is contract receivable because you have to receive the remaining. With the contract payable, it happens when the amount billed is less than the cash you are receiving. You billed 10 million, sorry, you billed 8 million, but you are receiving 10 million. So the remaining to me is a liability. You are receiving more than you are billing. So it's a contract what? Payable. It's a liability. So it's contract what? Payable. Are you following? So in the final position, we calculate two things: contract asset or liability, and then contract receivable or what? Payable. In some questions, you see that the contract, the cash received will be the same as the amount billed. If the cash received is the same as the amount billed, there's no contract receivable, there's no contract what? Payable. Okay, so take note of that. You will not always get contract receivable or payable in a question. You will not always. Okay, but just know that to get a contract receivable or payable, we compare the amount billed with the cash received. And then with our contract asset or liability, we compare revenue recognized then with less amount billed to date. Are you following? I said finance statement items are to what? Date. So that's how we present them in our books. We have examples to go through, but let's do that in the next video. Okay. So in the next video, we'll go through let's go through 4 examples, and we have other items or stuff to cover. We have principal versus agents, sale with right to return, repurchase agreement, bill and hold, and we have consignment inventory, consignment sales, right? So let's pause here and then continue in the previous video. Sorry, let's pause here and continue in the next video. We have looked at the financial position. We said the first step, we calculate about profit or loss. The reason is to get whether we have onerous contract or not. Step 2, determine the progress. Step 3, statement of profit or loss. Step 4, financial position. But there's something here in step 2. It says we should determine the progress. But they said where we cannot record or where we cannot determine the progress. It says something here. It says something here that revenue, it says when progress cannot be determined. Okay, if you look at our ways of calculating the progress, the first one, the input, we said is cost to date over cost to complete. Sorry, cost to date over total cost by 100. Let's say you cannot estimate your cost to what? Complete, and therefore you cannot estimate your progress. Okay, or let's say with the output, it is work certified over total contract price. Let's say you can't get the work certified, and so you can't determine your what? Your progress. That's why saying if the progress rate cannot be determined, here it says revenue should be recognized only to the extent of contract cost incurred. That will be recognized. That will be what? Probable. That will be probably what? Recovered. What's saying that? What's saying that is very simple. It's saying that okay, if you can't determine your progress, record revenue in the way that your cost to your contract cost will be what? Recovered. So if you can't get the progress, what does it mean? You see, we apply the progress rate on the total contract price to get the revenue to what? Record. Are you getting it? So if you can't get the progress rate, you can't get revenue to record. It's like saying, okay, if you can't get the progress, go and pick your cost of sales or cost to date, okay, as your revenue. Take your cost to date as your what? Revenue. That's all. If you can't measure progress, take your cost to date as your what? Your revenue. So if you take your cost to date as a revenue, you get zero profit because you are taking cost of sales as a revenue. So if cost of sales is 2, you use 2 million as a revenue, and you can't use your 2 million the same as the cost of sales. So you record what? Zero profit. So that's why I say, okay, if you can't measure your progress, record revenue in a way that your cost incurred will be recovered. That's what it means. So it means that if you can't get the progress, record cost of sales or take cost of sales, take cost to date, cost you've incurred to date as a revenue, and that will give you zero profit because revenue will be the same as the cost to date or the same as the cost of sales, and you get zero what? Profit. So that's all. If you can't measure your profit or if you can't measure progress, look into the question, get your cost to date, take your cost to date as revenue, and take your cost to date also as cost of sales and record zero profit. So that's it. That's it with the performance obligation over time. So we are left with some small questions to solve, and then we'll look at other areas, okay, like bill and hold, consignment inventory, repurchase agreement, and that will be it. Then we'll be done with IFRS 15, right? So I'll see you in the final part or the last video on IFRS what? 15.